holiday is over, or is it? That's the question we ask ourselves here on a slow start to Wall Street trade on the first week of December. This is Ilya Spivak, head of global macro here at Tasty Live, and this is Macro Money. We're going to take a look at why this week might bring some more interesting price action as the days progress, because there is indeed quite a bit of interesting fodder here on the calendar. But first, we'll try to anchor ourselves a little bit in the macro narrative more broadly, take a look at what happened on last week's shortened price action, and whether there's really anything there that can really be extrapolated out and whether it means anything going forward. As it stands, kind of a slow start to Wall Street and kind of a slow outing last week. We can see the S&P 500 adding 1.1% last week. That's a slight, I suppose, down step from the prior week's 1.5% gain, but kind of quiet overall. NASDAQ 0.7% in the green after a 1.7% gain the prior week. So limping along slightly in the right direction for the bulls, but not really showing tremendous prowess, and a little bit of continuation today on Wall Street, but on very light volumes. So participation after the holiday still seemingly working its way back and not quite where we might say there is familiar conviction behind these moves. Where we did see more conviction last week was in the bond market, where there was a very strong move higher and a parallel pullback of nearly 5% apiece across maturities on the yields front. So we can see the 10-year down 5.1%, the 2-year down 4.9%. So that kind of give or take 5% move showing up really across the curve. At the same time, the US dollar takes a step back. The euro up 1.5% and the yen outperforming, up 3.4%, which seems a bit telling in and of itself. The yen, of course, is the perennially low-yielding major currency. They've been hiking rates recently and still are nowhere near even 0.5%. They struggled to get from negative interest rates to a positive 0.25% rate with much ado at every step in the transition. So needless to say, when U.S. interest rates come down, in so much as this marks a global pullback in borrowing costs because of the ubiquity of the U.S. dollar in global commerce, where when interest rates in the U.S. are lower, that means the cost of borrowing dollars is lower, and that means the cost of borrowing for virtually any kind of commercial activity the world over is lower. Not surprising, in that environment, a currency that yields little finds relative appeal because the opportunity cost shifts in its favor. And so not only is it telling that bonds had as big of a move as they had and yields as big of a slide, it's telling that the yen outperformed relative to euro as a kind of benchmark for general US dollar fortunes, because it really speaks to this idea that outside of the staid performance in stocks, the quiet performance in gold, where you got to wiggle lower by about 1%, but not much else, the continued stubborn range encasing crude oil, not allowing it to go anywhere for a few weeks now, all of this seems to tell one kind of story, and it's a bond markets and a rates story. And it appears to be one where the familiar speculative narrative is running out of juice. You can see here what has been happening in the markets basically since the beginning of September as one kind of adjustment. At the top here are break-even rates. These are the bond market's inflation expectations. They're derived by taking the difference between nominal and real interest rates, so nominal bond yields or TIPS yields. And what you then get is the inflation adjustment you need to get from nominal to real. And the implication, of course, is the actual priced in inflation expectation as the bond market sees it across maturities. And you can see here, this has been going up steadily since the beginning of September, the month where the markets already knew going in, this would be the month where the Fed would start to cut rates. Or since then, the Fed has given us a 50 basis point cut that month and another one in November. This one's standard size, 25 basis points. But already when this occurred, right here, we can see we marked the bottom in bonds. At the bottom here is nominal yields, the 10-year, the 30, and the 2. You can see they start to go up in tandem, as well as the US dollar. This is the DXY US dollar index. They start moving up together, even as the yield curve itself shifts from inversion to positive territory and starts to edge higher. So you get this idea that as you have this adjustment from the Fed, you also have the markets reasoning this adjustment will be reflationary. This is not a response to some sort of economic crisis. This is easing atop an economy that's growing fine. That means the dollar's yield advantage is increasing. That means there are likely to be fewer rate cuts, at least in the aggregate for this cycle. And although the Fed has basically talked its way into 50 basis points in cuts after September, half of which it's already delivered in November, the other half likely to deliver this month, the overall cycle through the end of next year is a more modest one. You can see that in the way the policy expectations have evolved. Now, for December through the end of the year, we can see the market is only seeing 11 basis points priced in, which is a little bit light relative to what the probabilities actually look like. We can see here that once you adjust for the dates here, you get a little bit closer to 62% likelihood. If it was just the straight monthly quote from the Fed funds futures contract, which is what we see here, it would be 11 basis points. And of course, 11 basis points out of a 25 basis point rate move amounts at face value to a less than 50% chance of a move, only about a 44% chance. But once you adjust for the fact that the meeting happens not at the beginning of the month, but relatively late on the 18th, the likelihood, the probability structure shifts a little bit, and you get a little bit north of 50% to close to 62.5. So the market is tilting in this direction. Nevertheless, the overall story, 72 basis points through the end of next year, with basically 2 cuts and maybe some slight probability of a third for next year, that has, since September, marked a significant shift. Even if we take out of the 232 basis points here, the 75 that have already been delivered. Because, of course, what we have on the screen here is the Fed's 50 basis point cut here, the 25 basis point cut right there. So what you're looking at then at this point is a significant shift in Fed policy expectations from about 157 basis points on the menu for next year, so call it 5 cuts, here at the turn, absent the ones that have already occurred, down to 72. So about half. If we take out another 25 basis points and assume that next year is the only question that we're looking at, and the December cut will happen as the probabilities suggest, we are down to 132 basis points for next year, or from 132 basis points next year to 61. So again, a cut of more than half. So the story has been relatively one-sided, and it's given us a stronger dollar, it's given us weaker bonds and higher yields. The real question then for the steps that follow is whether this story has run out of speculative juice now that much of the data is out of the way, now that the election is past us and its immediate speculative implications have entered into the asset valuation conversation. We, of course, are going to get much more on this. There's 4 years of policy revision ahead, but that'll have to come for when it actually arrives and when there's some meat on those policy bones. For now, we've just had the market signal that the commanding win for the president-elect and the rightward shift for the legislature will be inflationary in the sense that it disrupts labor markets with new immigration policy and disrupts external trade with new tariffs. We saw that from the bond market. That's not a point of speculative contention. We've already seen that response in markets. The question really is now of degree and of whether those expectations are in any sense met. But that's going to have to come for when the new administration is in place and when it's doing things more likely than anything that still has speculative room to meaningfully impact things right now. With that in mind, the bogey that we're left with is the Fed itself. And there we actually have some meaningful event risk this week, which starts with the service sector report from the Institute of Supply Management. We've already seen the manufacturing side of this. It came out not too far from expectations. 47.5 was expected. 48.4 is what came out. As ever, this operates on the typical PMI logic where 50 is neutral, above 50 is expansion, below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. And so, in essence, what we got from manufacturing was contraction as expected, but at a slower rate than expected. In other words, a slight positive surprise, but ultimately a familiar range for the series. The next bit that we're going to look at here is going to be the more impactful part of the story. That's the service sector. The expectation there is that we're going to come off a little bit to 55.5 from 56 in the prior month. That was the highest in 2 years. So the service sector here, we can see growing at a blistering speed. And the expectation for this month is that we'll only have a slight down step. If we look at the internals of the manufacturing report, just to get a sense for some of the dynamics, at least on that side, we can see the inflation component ticked lower in the past month, even as we shrank at a slower rate. A lot of the upbeat news here from new orders, which returned to growth for the first time since the very beginning of the year. And then in employment, where things continue to be in contraction territory, that is below 50, but the pace of employment contraction significantly slower. In fact, the slowest we've seen since mid-year. So generally kind of positive green shoots in the manufacturing report, despite the weaker headline, and something that augurs relatively well for the service sector, where as we can see from the latest inflation numbers, that's where demand lives at this point. On the goods side, maybe we're going back to positive contributions from the goods side to demand and therefore to inflation over time. But needless to say, it is the service sector where the overwhelming majority of inflation lives that is the key consideration for the Federal Reserve. And so these incoming service sector numbers will be critical. Now, we'll look at that in conjunction with the other big piece of economic data because the upshot from the two is likely to be the same. And that's, of course, the official employment report for November that's coming up at the end of this week. The story there looking for a rebound. A measly 12,000 jobs were added in October, but that's been written off as reflective of one-off factors like hurricanes and factory strikes, in particular at Boeing, and basically written off as probably an episodic one-off. The expectation this time is that we're going to come back to basically the middle of the recent range with a gain of 183,000 jobs. Maybe that 12,000 gets revised. Maybe it even gets revised higher. We'll see what happens here, but the expectation for the running number is a return to 4. The unemployment rate, where there's less volatility, less revision, is expected to give us another jobless rate unchanged at 4.1%, so a bit off the recent peak here at 4.3 and essentially holding at standstill. Now, for both of these releases, the ISM numbers and the jobs numbers, this seems to be critical. The reason that the markets seemed to be primed to interpret any Fed easing as reflationary seems to have to do with the way U.S. economic data has been behaving since late August. Where we can see right here from this index by Citigroup, it started to turn a corner and improve. And as the data improved, we seemingly got the makings of what's going on right here. We can see already from August going into September, the yield curve is getting closer to uninverting. Inflation expectations are already starting to inch up. That's before the Fed meets, before they issue the jumbo cut, before they issue the dovish guidance. So the market has already spied that any kind of easing will probably look reflationary, and it's because momentum in the data by that stage had already shifted. That trajectory may be running out of steam now. Generally speaking, it seems to be that when this surprise index rolls through its 20-day average, which is about a month, you have turned some kind of a micro-cyclical knob where with each month's economic data, it isn't just the data and the economy itself that evolves. Since this is an index that measures outcomes relative to expectations, it's the expectations that evolve. Analysts look at this and say, well, perhaps we need to adjust our models because the economy here from late August through basically the end of November is increasingly outperforming relative to expectations. Well, maybe the expectations are wrong and the economy is just hotter. And the models need to be adjusted. The assumptions that go into them need to be reassessed. Well, invariably, that sort of process gives you regression back to data that's closer in line with forecasts because the forecasts themselves have been trued up. So when you get through the monthly average on this index, the 1 month average, that seems to roughly line up with when the turn of the knobs has started to really have an effect and expectations have started to get adjusted such that incoming data lands closer to them. If that's what's going on here, given that we already have a bias in the Fed structure, because rate cuts are almost certainly on the menu to some extent. The recent Fed comments have made that clear. And indeed, comments from Fed Chair Jerome Powell this week are likely to reiterate as much. He's speaking at the New York Times Dealbook Summit midweek. He'll probably echo much of what he said both the week after the November FOMC announcement and at the press conference immediately following it, all of which suggested that indeed the Fed has recognized that its aggressive dovish stance in September was probably overdone. So the comments broadly endorsed this readjustment in markets, and this one, at least directionally, there's probably more of the same there this week. But with it and the data, the question really is, well, okay, but how much of this don't we know already? And to that end, we come back to what this started to show. If the narrative has indeed run its course, at least for now, if we have spent the speculative juice on reflation, on fewer rate cuts, on U.S. economic data getting better than expectations, if the data cycle has rolled over, and now data is going to start to get closer to expectations, and the quotient for surprise is diminished. If the Fed has talked its way into rate cuts, but probably not as many of them, and rate hikes remain firmly off the table, then it's a narrow path ahead. And surprise risk is asymmetrically biased in favor of that narrow path unless the incoming numbers are so vastly off that a whole structural rethink is in the cards. That seems inherently unlikely and inherently a long shot. So with that in mind, more of this may well be in the cards. Still higher bonds, a pullback in the US dollar, not because reflation as a story has ended, not because the Fed is not going to be relatively supportive of the dollar with a less dovish stance than other central banks next year, but because the immediate outlines of that story here and now are already known. And there may be some distribution of speculative positioning just because those tactical bets that were laid on to take advantage of the adjustment that's been had so far, some of those have run their course. Because if they were looking just for that adjustment, it's pretty much there already. And that may give us a reshuffling of markets in a counter-trend direction for no other reason than it's out of fresh fodder to keep going. And the real question, and the big one going forward, is to what extent is the very extended up move in stocks a similar story? It hasn't been one so far, but it is not a stretch given what's happened already in the dollar and in the bonds to say that stocks too might correct lower for no other reason other than the status quo is maintained by the U.S. data and Chair Powell, and there's just not any more fodder for these trends to continue, at least for the near term. And that is Macro Money for today. We are back to our regularly scheduled programming, so we're here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things go therefrom. Back with Victor Jones for the Price of Truth on Wednesday. On with Victor and Tom for First Call on Sundays. On for Futures Power Hour earlier today and Friday with Chris, writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Thanks very much for joining. Happy trading. Macro Money's back tomorrow.